Good morning, students. I am Prof.Sovan and I am going to take one chapter from direct taxes called income from business and profession. Now, as far as the income from business and professions is concerned, this is out of the 5 heads, it is very important head so far. Under that particular head, income from business is being computed as well as the income from profession is also being computed. Now the question arises, in case of business we have all profit and loss account and the trading accounts as well. Now if the question is to pay tax on the profit earned by the business, so we can easily say that I want to give tax on the profit which has been shown in the PL account. But trading and PL account, keep one thing is in mind, that trading and PL account is being prepared as so far as the rules considered in financial accounting. But as so far as the tax authorities are concerned, they have their separate some issues for computation of taxable profit under business. Now if the question is, as I told previously, if the question is to pay tax on the profit earned by any business, we can easily say that I want to pay tax on the profit which has been shown in the PL account, like this. Please see, if we have one trading and PL account, trading and PL account. Now you have, under trading and PL account, you have some direct incomes as well as indirect incomes and direct expenses as well as indirect expenses, and you will get your net profit. So if you want to pay tax on that particular net profit, we can state this matter like this: I want to pay tax on all the items shown in the credit side of the PL account, and I want to get deducted by these amounts just because of your all incomes has been reduced by all these expenditures shown in the trading and PL account. So we are claiming deductions on all the items shown in the debit side of your trading and PL account. But the question is that here is the problem lying with income tax authority. Income tax authority clearly says that you cannot get deduction on all the items which has been shown in the debit side of the trading and PL account as far as the financial accounting is concerned. You cannot get deduction on all the items shown here, as well as you cannot be able to pay tax under that particular head either or not taxable income at all which has been shown in the credit side of the PL account. So your profit needs one reconciliation. Your profits, I repeatedly said, your profits need some reconciliation. Now the items which are not been deductible but also shown in the debit side of the trading and PL account called inadmissible expenses, and that should be added to your net profit. And the income which are not taxable at all or not taxable under that particular head which is being included in the net profit should be deducted. So you need one reconciliation to get the corrected net profit, or rather the taxable net profit so far. But in the first class of my virtual session, I don't want to discuss for all the items which has been inadmissible or all the incomes which are not being taxable. I just want to focus on a single item called depreciation. I repeat, I just want to focus on a single item called depreciation. As you all know that we generally show depreciation, which is which plays a very vital role for preparation of the financial accounting or final accounts, and is being shown in the debit side of the PL account. That particular depreciation is being calculated either on the basis of straight line method or on the basis of written down value method. But income tax authority has their separate method of calculating depreciation called block method. Now what is that particular block method? This is most easier method than that of the straight line or reducing balance. Now the question is that before coming into the block method, I have to tell that that particular depreciation which is being shown or calculated as far as the financial accounting is concerned, that should be added with the net profit as inadmissible expenses, and the depreciation which is being calculated by the income tax authority under block method should be deductible. So depreciation plays a very vital role in the reconciliation system. Now, what is that particular block method? Under the income tax rule, no individual assets to be taken into consideration for calculation of the depreciation. They use a block. They generally use a block of certain percentage, like 5% block, like 10% block, like 20% block, and so on. The assets that particular blocks might have the combination of 2 or 3 types of assets which got the same rate of depreciation. The block method generally focuses on the similar type of rates, that is 5% block, 10% block, 20% blocks, and so on. And that particular block might be the combination of, say, A plus B, that is A and B. Both machines are there or both assets are there having a different value. Now, if you purchase any asset having got depreciation rate of a certain percentage like 5%, that entire purchase price should be added to that particular block. And if one, say for example, C purchased, right? So A plus B plus C, A plus B plus C. Now the point is that if any asset is being sold out of that particular block, it is not the considerable fact that that particular individual asset to be taken into consideration. This was the WDV, that is the sale price, that is the profit, that is the loss. No. Under block method, we are supposed to deduct the sale price of that particular asset from the entire block. Like, say for example, I am just giving you some numerical figure. Say for example, A and B. Say for example, A and B was valued, say A 10,000 and B 15,000, and total block value was 25,000. Now C purchased for another 15,000. Now the block value is 40,000. So if you sell individual asset A at rupees 20 or rather 15,000, so deduct 15,000. It is not the considerable fact, as I told you before, which the asset which is being sold out having a WDV of 10,000, now it is being selling at 15,000, 5,000 profit. This is the considerable fact under financial accounting system, where we supposed to calculate the profit and loss earned by the sale of the particular asset and supposed to show it is in the debit or credit side of the PL account subsequently. Now the point is that under this block method, if A asset is being sold out at rupees 15,000, the entire 15,000 will be deducted from 40,000 and the rest will be 25,000, and that will be the combination of the price of B plus C. It is not, again I am saying that it is not the considerable fact that B and C comprises of 25,000. What is the value of individual B and what is the value of individual C? Now, it is not the considerable fact. That particular block has got the value of 25,000, and at the end of the year, what is the rate of depreciation? 5%. Now, that particular 5% is being charged on the 25,000, and your annual depreciation, deductible depreciation, is 1250. So you can get deduction as per block method, calculated depreciation of rupees 1250. Like this, another block can be made. Like this, another block can be made. So it is all about the rate of depreciation which consists of a single block and the WDV of the block, add purchase, less sales consideration. The simple fact is to calculate depreciation, WDV of the block, add purchase, less sale. So the value left to be depreciation, or the rate will be charged on that particular value. Now, in the next step, we can face two exceptional situations while calculating the depreciation under block method. What is that particular exception? Number one, there are physical asset exist in the block, but block value reduced to 0. Physical asset exist in the block, but block value reduced to 0. What is that particular situation? Say for example, one block consists of A 10,000, B 15,000, total block value 25,000. Now if A asset sold for 25,000, then what happened? Now your WDV was 25,000 less A sold for 25,000. Your block value, WDV of the block is nil, that is 0. But physical asset, which is called B, exists into the block. In that particular situation, no depreciation will be charged on that particular block. So here is the, I repeat, here is the first situation, exceptional situation where physical asset exists in the block but block value reduced to 0. Example, A 10,000, the block value was 10,000, B block value was 15,000. Say for example, total WDV of the block was 25,000. Now if A asset only A asset is being sold for 25,000, your block value reduced to 0, where your B asset, that is a physically exist, that B asset physically exists into the block, but no depreciation will be charged in that particular situation. Now exception number 2. Exception number 2, where value of the block exists but assets in the block are ceases to exist. That means there is no physical asset exist in the block, whereas there are some positive values exist in the block. How can it be possible? There is no asset exist in the block, but there are some positive values exist in the block. So for example, the same example, A asset 10,000, B asset 15,000, total 25,000. Done. Now if we want to sell A and B, both the assets at 20,000 total. Now what will be the situation? What will be the effect? That is WDV of the block 25,000 less sold A and B in case of 20,000, now 5,000. Your 5,000 value exists in the block, whereas your assets in the blocks are ceases to exist. There is no physical asset exists in the block. In that particular situation, instead of having the positive value in the block, no depreciation will be charged. These are the exceptional cases. In both the cases, we are not supposed to charge depreciation on that particular block. Next, come to the last scenario of our discussion. That is there is a condition given by the income tax authority that it is not a considerable fact कि one asset which is being purchased in which date. As far as the financial accounting are concerned, we are supposed to consider the dates of purchase. That is 6 months depreciation, 4 months depreciation, 3 months depreciation. We are being allowed to charge the proportionate depreciation as far as the financial accounting is concerned. But as far as the income tax rule rather, they clearly said that one asset must be put into use for at least 180 days in the previous year. If it is not being used, For at least 180 days or less than 180 days, half of the rate of the depreciation will be charged on the purchase price of that particular asset. Half of the rate out of the WDV left after selling or buying, out of the WDV left, the purchase price, on the purchase price half of the rate will be charged, and on the balance of the WDV full rate of the depreciation will be charged. Let's take one example. Say WDV of the block of 5% depreciation consists of A and B was rupees 1 lakh. C purchased for rupees 50,000 and put into use at December 31st. Calculate depreciation as per IT rule. Calculate depreciation as per IT rule. If A asset being sold out under three situations, like 70,000, like 1,10,000, like 1,50,000, like 1,50,000. So we are taking these three situations into consideration. WDV was 1 lakh, add purchase of C 50,000, 1,50,000 will be the balance. Now less sold C. In first option, C was being sold for 70,000, 1,10,000, 1,50,000. Now the point is that what is the WDV left? 80,000, 40,000 and nil. Now in case of first situation, we have 80,000. As C was purchased 50,000 and put into use on December 31st, it has not been put into use for 180 days during the previous year, just because of January, February and March. Thus do not consist 180 days. Now the point is that, so on the 50,000, on that particular 50,000, we are supposed to charge half the rate of depreciation, that is 2.5%, and on the balance we are supposed to charge the full rate of depreciation, that is 5%. Now, what will be the depreciation under situation 1? That is, under 80, out of 80,000, what is the value of new purchase? That is 50,000. Now, on 50,000, 2.5%, and balance on 30,000, 5%. So, what will be the total depreciation? 1250, no, 1250, 625. 1250. Now 5%, that is 1500. So 2750 will be the deductible amount of depreciation. Now come to the situation number 2. Here we have 40,000 left as balance, but we supposed to charge half the depreciation on the new value, that is 50,000, but we do not have more than 50,000 here. So until and unless we cover that particular amount, that is 50,000, the new value, we are not supposed to charge depreciation for the full rate. So on the 40,000 we supposed to get half the rate depreciation as well, 1,000. And under that situation we faces the same problem where values of the asset does not exist, but physical assets, that is B and C, that is C purchased A, sale of A, okay, sale of A, where B and C assets do exist in the block, but values of the assets is not present here. So we are not supposed to get any depreciation or rather charge any depreciation under situation 3. So here is all about the lecture for depreciation. In my next session I will come to the rest of the items which are being inadmissible or which are being clearly discussed to calculate the taxable profit under business and all about the reconciliation. So this was the total concept of depreciation which is being calculated under as per IT rule, and I hope you people got understand what I want to share with you. If you have any sorts of problem, just come to the inbox and comment box, either inbox or comment box, and I will try to solve your problem. Okay, goodbye.